I'm John Hanna for CDTV.net in New York, and we have Greg Womack, president of Womack Investment Advisors at Edmond, Oklahoma. Greg, with the stock market at 9,500, thinking about how people are looking at their gains and saying, is this going to go higher, or should I protect my gains? Like myself, when I used to trade before, I'll be thinking about, well, wait a minute, what if this stock goes up some more? Am I losing out? What are your thoughts on that?
Well, the market, John, has made significant moves from March lows, up 50% or more on the S&P and almost 60 on the NASDAQ. So, a lot of people have invested, who did invest, somewhere between March and April and even May and June are up significantly. And so I think it's important that we do protect profits when you have them. So, what are some signs we look for is if you're in a stock and it's doubled in price, that might be an indicator to say, hey, I want to take my money off the table. And so you would perhaps set a limit and sell and get your money off the table. Now you're playing with the house money. And then even with that, you may even want to put a sell stop in on the remaining shares to protect your profits and gains. But you also want to look, so if a price is doubled, it's a good time to take profits typically. But you also want to look at a chart. We've seen some stocks make significant moves. I mean, you look at oil trading at the 30 range, now it's 74. I mean, that's well over 100% double. And so look at a chart and see if a stock has extended above its 200-day moving average of 200% or more above that 200-day. That's usually a good sign that the stock may be at some point topping out. And so you'll want to consider taking profits there. Another one is if the market starts to show signs of weakness and breaking down, then you want to be really cautious and be ready to take profits. So those are three areas: when the price is doubled, when it's 200% above its 200-day moving average a price line, and also if the market starts to weaken. So how do you do that? How do you protect those gains? One is one probably low-cost way is to use a sell stop. That's where you say, well, the stock's trading at 50, and if it drops to 40, 49 or 8, I want to get out. So you put a price in. If it hits that price, it becomes a market order. And so that's the benefit of that. And you can also use what they call trailing stop sell stops, so if the stock moves from 50 to 55, that percentage increase, the sell stop price will automatically trail up to 5%, for example, above or below what is trading at that time. So any significant moves, the sell stop adjusts in price accordingly. That's called a trailing stop or a sell stop. So that's one way to protect your gains. Another one would be a little more sophisticated, but using a call option that says, hey, if it's trading at 50 and if it hits 52, I want to sell an option to get out, either all of it or maybe portion of your shares. That way, as the stock moves up, you're capturing that higher price, and chances are the stock could get called away depending on your option strike and the expiration. And you make an income while you sell that call option. So those who have sold options before, you know what I'm talking about. If you haven't, you really want to do your homework, or you have your broker walk you through and talk about these items. A little more sophisticated way, even than a call option, is to buy a put option. Because the problem with the sell stop, John, is let's say that the stock is trading for $50, and for some reason, negative news came out on the stock overnight. It opens up the next day at 40. Well, your sell stop that you had in at 48 becomes a market order, and you may only get $40 or less out of that stock because it became a market order. So that's the problem with a sell stop in, is it becomes a market order, but if it keeps moving down before your order gets filled, you could actually give substantially less. We've had that happen before. So buying a put option in lieu of a trailing stop or a stop order says, I'm going to buy an option at 45 on a stock that's trading at 50. I'll buy that option that says if it moves below 45 or lower, I am out at 45. I can put it to the buyer, to the whoever bought that option. I'll put that to them at $45 and get out. So that put option prevents slippage that a self-stop doesn't. And so those are two ways to protect your downside. And of course, you can always just sell outright if you want to protect your gains. I know it's a little technical, but those are how we protect gains: is using a sell stop or buying a put option if we want to protect the downside. And we also will sell a covered call sometimes to create the income to buy the option on the downside protection. And so that way it's not costing you anything to buy that put option. So those are some of the things that we do, but we always encourage people to look at a chart before making these decisions. And here's something else, John, is you want to look for where do you put your sell stop in or buy your put option. You want to look at a chart and look at previous lows to say, if it stays above these previous trading lows, I'm okay. And I don't want to sell it too soon. But if it breaks down below the previous lows or what we call support levels, that's where you want to put your sell stop in, just right below that, to give it a little wiggle room, to move around, because sometimes the stock will come off its high some for maybe a few days or weeks, but then excel higher in momentum down the road. So you don't want to give up too early, but if you want to protect those gains, look at support levels, look at your trend lines, and study a chart, and then put your price in.
That's Greg Womack, President of Womack Investment Advisors at Edmond, Oklahoma, and I'm John Hanna for CDTV.net in New York.